Let's try to pin all this together. Someone that can help us with that, Michael Feroli of JPMorgan Chase. Michael, your thoughts as you see yields go to where they weren't in your economic textbooks?
Yeah, it's obviously not sending a very good message about the market's expectation for the economy. So I think it does, as you mentioned in the outset, reflect more concerns about Europe necessarily than U.S.-focused concerns, but it certainly doesn't send, as I said, a very good vote of confidence in the outlook.
What is the task of the United States Central Bank in assisting Europe? Do they provide academic advice? Does everybody say, leave us alone? What does the Fed do?
The Fed doesn't have a lot of options for addressing the European issue. The swap lines that they've opened with the ECB are of unlimited size, so there's not really much more they can do there. Clearly, if things get worse, QE remains an option, but with rates this low and given the Fed's rationale for QE, that it's to lower the long-term interest rates, it's questionable how much extra bang for the buck you're going to get there. There is the option of reopening some of the liquidity facilities should some of the financial issues spill over to U.S. markets. But right now, I think the Fed is mostly has to sit there and watch it like the rest of us.
Michael, let's bring up dreaded first chart. Here it is, folks. And it is the Bernanke Fed funds target rate. And the important thing here, not only from 1980 and the great disinflation, as you can see that flat line in the lower right corner, that is a persistency of the chairman at the zero bound. Michael Feroli, is this a vindication of what we read from Paul Krugman and others of a liquidity trap? And are the people worried about higher interest rates just wrong?
Well, they've been wrong so far, and I basically think they're going to continue to be wrong. The Fed is very likely to keep rates low for a long time, and what's going on in Europe is not going to hasten that. So it's hard to see rates moving up significantly in this world, and so I think the liquidity trap theory is once again playing itself out here, just as it has in Japan over the past decade or so.
Let's bring up the number, folks. We'll probably show this again in the hour. This is the perspective of the euro through 125 today. But where is the euro? Going back to early 1999, here's where we are right now, $1.24 per euro. The peak of enthusiasm was $1.56. They were buying everything in New York except Michael Feroli's condo. $1.56 in May of 2008. Bring it back up again. I didn't have it memorized. Sorry, William. There's euro weakness and dollar strength, 0.87 in February of 02, and the euro came in $1.16. Michael, do you have any clue with your economics team the fair value of the euro right now?
I don't have a very strong feeling on the fair value of the euro right now, but one thing I would add to what you just mentioned here is that the dollar has been strengthening against a lot of currencies, and actually it's up about 7% on a broad trade-weighted basis over a year ago. And so that is going to be a pretty significant headwind for exports. So, when we talk about euro spillovers, I think so far a lot of people have said, well, on the trade front, trade with the Eurozone is less than 2% of GDP, but what we're seeing in this latest flight to quality is that the dollar is strengthening against a lot of our trading partners, and so it's going to be a headwind for exports, I think, more generally for the U.S.
Let's look at what Michael Feroli just spoke about, folks. Here's a trade-weighted dollar, and you can see it here from 2006. Where my hand is, I don't know, Victor, you get my hand up here, is the strong dollar policy, and down we go like this, and here's 2006, and here's the Feroli rebound here, up about 7% in the dollar. Michael, how does that affect American business? We're having a manufacturing renaissance. Ann Dignan talks about that a lot in the Middle West. Is this going to affect our manufacturing and our agriculture export renaissance?
It's going to make it tough for manufacturing, which so far has had a pretty good recovery. Since this recovery began in the middle of 2009, exports have added, on average, about a percentage point to GDP growth. And given the slowdown in global growth, given the strength in the dollar, it's going to be really tough, I think, for manufacturing to sustain that kind of strength. So it definitely does throw the manufacturing renaissance into doubt here, I think, for the next 12 months. Why
are the markets on the move? Why are we down 160? This is what greeted us this morning in New York. I mean, Sarah Eisen was in at 2 a.m. She was so excited about the euro, but here's QE there, QE here, and this is simply European confidence rolling over in a tough number this morning. Michael, what is your measurement of American confidence right now? Are we more confident than Europe?
Well, but that's not a very high bar to cross. Confidence recently has been mixed. It has been getting a little support from falling gas prices. On the other hand, the labor market does remain a weight on confidence. So, the latest readings we've had on confidence have been kind of going in both directions, but it's certainly better, I think, than European confidence.
I talked, Michael, about the brutal moves as we talk about President Trichet's favorite word. Victor, wander over here, and I want to look here at a brutal move. Here is a 10-year yield from the beginning of the crisis. And down we go with this beautiful regression. And you can see how we've just simply broken down 2 standard deviations off the crisis trend. Michael, as an economist, you're concerned about these sudden shifts, what Trichet called brutal moves.
Right. The move we've seen recently has been pretty brutal in rates. And as I said earlier, I think that tells you 2 things. One is that the expectation for interest rates is low for very long, and 2 is that there is a massive flight to quality right now, and so neither of those things speaks very, very high of the outlook for growth, both in the U.S. and globally.
Let's look at the note of the day here. I thought this was great. Dennis Gartman, always good. Boy, did he capture this today, almost laughably. It's comical and it's sad at the same time. But this is a Ponzi gone truly awry. I'll buy you, you buy me, and we'll buy each other with each other's money. I love that, Michael. I think that really captures the view from America. The sovereigns give the money to the banks give the money to the sovereigns, and they just try to keep it going. Are we with all of your research capabilities, are we at a tipping point with this, not Ponzi scheme, but with the circuitous fixed income market of Europe?
So I think we are at a tipping point, and I think the thinking that we could wait until the Greek elections on June 17th and then have some European response after that is now looking a little stretched after what we've seen in the markets in the past 48 hours. So I do think it's incumbent upon the European leaders to act pretty aggressive in a matter of days here before things could get really ugly.
So much to talk about within the data, and here is, again, the 10-year yield far below the Lehman low. We talk about that of early 2009, that dropped down, and you can see how we've grind down even further. Michael, when you talk to Bruce Kasman, do you reaffirm QE3 or 4 or 5, or are you hesitant because there's been a bit of good economic data?
Yes, I'm not convinced that we're going to see QE3. 2 things I think are going on in the U.S. economy. One is that we've been seeing the unemployment rate decline, and the other is that core inflation and headline inflation, for that matter, are right on top of the Fed's preferred comfort zone or inflation target. So without either of those moving in a direction that suggests either a deterioration in the labor market or a move to deflationary risks, I don't think it's obvious or apparent that we're going to see QE3 anytime soon.
I liked your note a week ago or 2 weeks ago on inflation. Is disinflation setting in with these rates, even if they're from the irrationality of Greece and Spain? With these rates, do you just follow on that we should see disinflation?
So, disinflation, I guess 2 years ago, we kind of thought, given the amount of slack in the labor market, that we'd see ongoing disinflation. But what we've in fact have seen is that while inflation is low, it stopped going down, and it's actually now hovering right, core inflation's right around 2%, depending on which measure you look at, and wage inflation's just a little below 2%. And so that's been a little bit of a puzzle, is that given the amount of unemployment we're seeing, that we're not seeing even more ongoing disinflation.